Great. Good afternoon. Thank you so much for joining us for today's conference call and presentation and Q&A. Certainly delighted to see a few familiar attendees. We welcome you. As in the past, we welcome you to submit any questions during Keith's presentation, and I'm happy to kind of address those in real time. Just go ahead and submit them in the chat, and I'll look for a appropriate time to mention them to Keith. So with that, we'll go ahead and get started, and over to you, Keith.
All right. Well, welcome everyone. Hopefully you've had a great summer. It was a great summer here in Rochester, and we're heading into the fall. But yeah, I just hope things went well from that perspective. But I'm just going to sort of review like we've done before. We'll start out with sort of where the fun started, where we're sort of evolving to, talk a little bit about some of the frameworks we've been using and maybe adding some additional areas of interest that we're sort of looking at also. But then also at the end, we've got sort of a case study on a compounder we found that's located in South Africa. But I think it sort of will go in the flow of the whole presentation here. So we've got the disclaimer. This is not investment information. It's for informational purposes only. And the details are in this slide. So, as you all know, initially we were sort of a value and special situation fund focusing on emerging markets and developed markets. We've evolved to include sort of, a growth framework in slower growing markets. So consolidation transition, we've pretty much all of our portfolio, we've got 95% plus is now focused on this strategy. And so what this really entails really looking at more of the underlying growth drivers of the business to ensure the business will meet what our growth expectations are for the business. And if the growth expectations aren't met, then we examine and see whether we think it's more of a temporary or a longer term adjustment. And then if it's not, then the valuation still doesn't really reflect that, then we'll end up selling it. And that's exactly what's happened with some of our holdings. I know someone had asked a question about Ash Tea, but that was what our assessment of what happened to Ash Tea is the growth profile had decelerated. The multiples still seem to be staying around the same. And so we decided to exit that into other positions where that trade-off was a little bit better. In terms of, again, we're sort of focusing on firms that generate excess cash. And so that our ideal company is a situation where the company it has some organic growth. And then in addition, it's generating excess cash and then skilled management can either buy, has a number of options to do with the cash. They can either buy additional companies. We like to find businesses that don't have heavy capital requirements. That's one of the transitions we moved away from is companies that have heavy capital requirements. So will have this excess cash. And then using this excess cash, either do one of two things, either buy other companies that will be accretive and or buy back shares or pay down debt. And so we like to find businesses that are just have a lot of cash available from that perspective. And then we also focus on sort of this destination analysis. We reviewed that last time we talked, and we'll go through it again to sort of give you an overview of what that is. I think it's a very interesting framework. It's basically looking at where do we think the business is going to be in 5 or 10 years. If I really don't have an idea of what that is, then in essence, that gets excluded from our universe. And then again, we're sort of examining competition in the strategies by sector, and you'll sort of see that in terms of where we are. These are just sort of the current characteristics. And one of the things I wanted to point out here is we sort of break them up by the types of businesses we had talked about before in terms of compound mispricing, mischaracterized firms. These are our themes, whether it's a public LBO, sort of consolidation, or whether it's a capital allocation champion. As you see, most of the management teams, if not most of the management teams here really have an overwhelming majority are sort of what I call a capital allocation champion. That means they're in a situation where they have excess cash flow and have reinvested it in a situation that makes a lot of sense just from the business's perspective. And then we've got growth. As you can see, the expected growth on most of these businesses is relatively high. And then if that happens in 5 years, the multiple we're paying today is significantly lower. So in essence, we get an average multiple. If you go way down to the bottom there, we're only paying for four times earnings for something that's probably growing in the mid-teens, which I think is a good characteristics of a portfolio. But what's behind this is looking at a company specific by specific basis and going through some of the analysis there. Over to the right is some of the characteristics of our portfolio. As you can see, compared to the other benchmarks, we have a lower PE or free cash flow multiple, a higher growth rate, and then our size is probably similar to the international small cap value, but we're not quite as big as the MSCI sort of world indices, which has much bigger companies than we typically invest in terms of our portfolio here. So in essence, what we've got here is here's sort of our starting point. We're looking for firms that have EPS and dividend growth of 15 to maybe up to 20%. And then we're identifying the moats, determining if the moat is widening. Again, taking a look at various things that would characterize that or not. And then we are also looking for management enhancing the moat via operational improvements or good capital allocation. These are some examples of companies in the portfolio right now that have a lot of these characteristics. There's TerraVest, and then there's Builders First Source, Asbury, and FFB, which are some of our highest, those are the highest percentage at this point in terms of allocations of the fund. As you can see, they all have modest forward PE multiples, and decent growth rates going forward from that perspective, and both the historical and the going forward estimated growth rates. And then there's some of these that are more modest growth, but still seem to have a good capital allocation. Example of that could be Aero Electronics, which again is sort of in a cyclical business, but the management has done a great job in terms of capital allocation of that business. And the one thing with the cyclical business, I asked you about Builders First Source in that too, is you're probably going to get more volatility in those types of businesses versus the non-cyclical businesses. And what will happen is even if the companies are performing well, since they trade with the rest of the other companies in that sort of space, they'll end up, trading and being more volatile from that perspective. And then one of the key things we sort of focused on is we're trying to look at our holdings, assuming no multiple expansion. We will basically buy companies that are selling for cheap multiples, so we think that expansion can happen. But what our focus is on businesses that can grow to that 15% plus with no multiple expansions. That's primarily through net income growth, and or stock repurchases that can get us to the 15% plus organic growth in those cases. So this is what I mentioned before previously about the destination analysis. The real question is what's going to happen in the next 20 to 10 to 20 years. So it's really looking forward and trying to focus on businesses where at least that can be predictable. Um, and that's been more of a challenge recently, especially with a lot of these emerging technologies. And one of the areas that, even though we still have a telecom, we've sort of moved away from telecom and media companies, which was sort of our focus, I would say, when we started the fund and up to maybe probably to 2 or 3 years ago, is basically because it's tough to, given the changes in those markets, it's tough to see what the market's going to look like in 10 to 20 years. And therefore, we've reduced exposure to those particular markets. Again, sort of look at the longevity of the returns. One of the key things is this disintermediation or disruption, which has sort of happened in the TMT space in a number of the different verticals. And then you know, and then you've got some of these companies that are basically expanding out. They do something in one particular area and then they expand out. The case study company that we're looking at, Argent Industrial, they've done a great job in South Africa, but then now they're expanding out to the US and UK and Canada and actually trying to reduce their exposure to South Africa, which is something we like, which makes, I think, that somewhat of an interesting and unique situation. And then, what types of scale efficiency benefits have been realized in the past and can they be realized in the future? That's sort of, again, just an exercise of looking at the underlying of the business. Operational leverage is a key piece of what we try to look for. How much operational leverage is really available to the business? And we could take a look at that, use the past as an initial guide, but then also really taking a look at that because that's where you're going to get companies that whose revenue growth may not be, exciting, but in essence, if they can increase margins, then that'll give you, then the business will can do well and do that in combination with buybacks creates a very interesting sort of profile that's there. So these are the areas where we sort of focused in terms of, our future looking forward. We've got distributors. Um, with growing end markets. I think that's sort of been a theme as you've seen over the past. So those would be companies like Asbury Automotive, Aero Electronics, these companies that are basically distributors and middlemen. And those companies can basically grow as the market grows, but then in addition, if they're good capital allocators and good acquirers, then they can add some value from those niches. And then also niche banks. We're also looking at some insurers and some financial services providers, because I think that's another area where we can find some stuff. And given where the valuations of those businesses are now, that makes them very interesting. And then we also have software. We've taken a look at some software companies and businesses, and I think that's an area that in the future you'll probably see more in the portfolio because that is a really interesting type of a situation. And then lower future returns, these are areas where we sort of have moved away from, has been more of legacy telecom and media due to the moats and capital intensivity and the competition. And we're focusing on, like I said, we talk about sort of these capital light firms, and that really allows management to, you know, if they're good capital allocators, to basically enhance value through capital allocation. And so that's sort of like this destination analysis is sort of in line with how we've sort of how our process has evolved over time and some of the key things that we look for going forward. You get buybacks, which also another piece add something there. And then so that's sort of some of the pieces how we've incorporated the sort of destination analysis into our overall process. Um, and then so we're talking about compound growth here. So we were looking for places where there's unrecognized growth that may happen in the future. Operational leverage can be an example of that. And then looking for firms that transition from low returns on invested capital to high returns on invested capital. We do an analysis, returns on incremental invested capital, which will give an example in our analysis of Argent. And you'll see over time what's happened there is they've because of the way that they've run the business, selling lower margin South African businesses, buying higher margin businesses located in UK and with divisions in the US and Canada, have basically increased returns on invested capital significantly. And they do that by buying businesses at relatively modest prices. So you really get a win-win-win situation. And then they've also used buybacks when they couldn't actually find businesses. And that's a strategy we've seen in a number of companies that have done well over time for us. And I think that's an example of what's going on there, and an example of sort of transitioning from a low return on invested capital to a high return on invested capital firms. Um, and then, we examine market factors and capital allocation to determine, okay. And some examples of that we talked about, like there's Auto Hellas has done that over time. They've done some very good accretive acquisitions over time. TerraVest is another example of that type of a business. And then Academy Sports hasn't done as many acquisitions, but they've used buybacks as and internal growth through organic store growth. Um, that particular company's had more challenges in the fact of just the economics of the business. They're tied to a lot of the sort of, I would say, mid to lower level socioeconomic factors in the U.S. And so that's what their challenge has mainly been versus the other companies that have had lesser challenges along those lines. And then the question is, where are the profit pools in the value chain? We will do value chain analysis and take a look at it. That's where we've identified some of the distributors and some of the other companies along those lines. And then, we look for accretive sort of consolidation growth, which we'll see is part of the story of these businesses as time goes on. So the value change analysis, we look for firms with large TAMs or total addressable markets in terms of can these businesses continue to grow and is there alongside. So the one additional thing we've added in here is insurance. Those are the other areas where we've historically looked at. We're starting to take a look at some interesting insurance companies along those lines from that perspective. We follow the value chain and then you're going through, you know, for example, for let's say an auto or something, a lot of people start out with the components, look at the components, the OEMs, the distributors, the financing and service, and find out where the biggest profit pools are. And so that's part of the analysis that we go through. And then some of the growth drivers for the large pools is sort of consolidation, organic growth, and then cyclical or transitioning businesses. What we describe as sort of capital allocation champions, these are guys that have really done well over time. Probably The best one I know of is a guy named Henry Singleton that's done a lot of has basically been a champion back in the 60s. He bought businesses, he rolled up high tech, it was all based around a semiconductor theme. Bought really good small businesses that were growing. And then what happened is in the 70s, the stock price went down and he turned around and sort of did buybacks of those businesses. But then in addition to that, he focused on operational efficiency and basically distributed management, which you'll see in a lot of our types in our number of the businesses, and even the one that we're talking about today in terms of our case study here of Argent is Argent actually is a business where this happens in South Africa, but it's a similar type of a situation. Setting up a culture that allows for that, where there's a relatively small, central main office, but in essence, each of the divisions are run sort of individually, independently, and there's coordination amongst them in terms of trying to get, let's say, lower costs for certain supplies or inputs, but it's pretty much each group is working in sort of an entrepreneurial type of spirit from that perspective. Um, and so got capital allocation. So the investment, how are they investing the firm's cash flows? And we got those various options that are mentioned right there. The real question, the one thing that's important in this is to have benchmarking. Is everything being examined so to understand how management's thinking about this? And you can tell that by just taking a look at sort of what's going on in the past. Have they made good capital allocation decisions, or the decisions been more, um, you know, is it clearly enunciated in terms of what they've done? The tool we've looked at is return on incremental capital deployed. So that gives you a snapshot of if returns on capital is increasing, at what rate is it increasing, and what will it eventually, approach as time goes on. And then the other thing in terms of benchmarking is how many shares are we purchased, and then is it a discount to the current price, and again, efficiencies over time in terms of trying to make the operation more efficient. And then we're trying to find, good growth capital allocation with low or modest valuation. And then it depends upon where is development, but I think there's a number of different sort of cases, and that's sort of what we're looking for as sort of an ideal type of firm that we would like to invest in. So we're trying to basically find these themes where we can get decent growth. I think we're trying to shoot for 20% with no multiple growth. And that would be a combination of either organic growth, M&A growth, and share buybacks are the three main drivers of that. And then trying to use those in combination to get 20% growth, assuming no growth in the actual underlying multiple. And we are buying firms where the multiples are relatively low, so that if those three aspects do generate 15 to 20% over time, we believe that the market will rewrite the multiple, and you'll get a combination of both a stock with improving, operations in terms of growth, and then an additional multiple re-rating from that perspective. And so two specific examples. If we're looking at distributors are a good example of where we can find these types of businesses. They compete in large fragmented markets. Most of the participants are sort of privately held. And then there's some that don't have any PE involvement, which reduces the competition for some of these acquisitions. Specifically, auto dealerships is one that's in that case, and there's probably others too, but that's the one that's at least that I know of from that perspective. And then the other area that we sort of focused has been niche financial services. Try to find very efficient spread lenders, high return on non-banking service like processing and other types of things, but having that be a material portion of the revenue, so it's not just an additional service, but it actually can drive a lot of it. That's the example in a portfolio company called FFB Bank Corp, where the processing revenue I think is on the order of 20 to 25% of the overall revenue, so it's significant. There are other banks that have processing, but it's a really small portion, so it's not really driving very much of the value of that business. Even though it's adding incrementally, it's not a big piece. Low cost deposit niches for finances, and then high yield loan niches where they can find, like for example, NBN is orphan loans, so they're buying loans from forced sellers, or SBA loans is another sort of niche that's there. We're trying to find, and what's happened, we've noticed in some cases there's been less competition due to consolidation, And then recently we've looked at more of sort of levered investment insurers. And what I mean by this is insurance companies that use their float as a low cost financing for assets on the asset side of the balance sheet, which which typically a good portion of them insurers have to be in fixed income and other smart capital allocators in terms of finding good, fixed income types of investments. But in addition to that, also having some aspect of sort of equities or other types of things that would sort of create a lot of rev create a lot of asset growth that's financed by the low cost financing of the insurance float. And so again, the key there is you want to find a good insurer that has, combined ratio below 100. And so you're basically financing investments with low cost insurance. And then you can figure out what the multiple, how much they can really be multiple. And that's one of the models we like from that perspective. Um, and then this is how you're going to estimate. We're going to get to, hopefully our goal here is to get to returns of more than 20%. I mentioned the net income growth and then the capital returns piece. Those are the two that we measure, and we try to get at least 15% on that. And then if the changes in multiples you add on top of that, that can get us to 20%. That's sort of like the model that we look for. And then these are some of the specifics that we've got in terms of the new investments. We've added a few of them recently. And we want net income and capital returns to be greater than 20%. And then we have 50% sort of a current multiple, saying we're buying it less than what we think that multiple eventually can re-rate to. And that over time will help out, will add on top of sort of the internal growth that we've recently talked about. And we ranked a number of these together, and then we have a list that we do with that, and we just sort of follow the companies and sort of see what's going on over time, and just ensure that the growth expectations are still in line, and the drivers behind those are still in place to allow the growth to really happen. So we're also just looking for companies that have sort of a best combination of growth and earnings yield. So the recurring revenue, this is for distributors. Distributors are basically in two businesses. This is just an example of sort of where we can find some of these kind of companies. New and used sales and value-added reselling services, which basically add a lot, which can be really high margin and very sticky. And then the new and used sales are sort of one-time revenue, and then the value-added services are recurring. We're looking as these businesses get larger and larger customer bases, they'll get more and more recurring revenue as you get customers that are returning. These things could be in areas such as, the auto dealerships or let's say come something like Arrow, which is an electronic distributor. But basically the recurring revenue can vary by type of distributor. If you're talking motor vehicle, there's different ones across different segments in motor vehicles. There's construction equipment, trucks. And so depending upon the specific type of product that you're distributing, there can be different characteristics there. And then we're looking for distributors with relatively high retention rates, as that can add to the model and make it a little bit more sort of sticky and recurring. This is similar to what you'd see, let's say, in the software business where you can get highly recurring revenues. This is just in a different context of actually distributors. And then this is the niche finance companies that we were talking about before, where the areas are. We've got efficient spread lenders. We want to try and find efficiency ratios, ideally somewhere around 40 or lower. There's reasonable NIMs, and then you got a sticky deposit base. You got a good amount of non-banking services, which are mostly banks. You'll see processing, credit card fees, and trust services being a large part. Some of them have other types of fees that they collect, especially if they service, let's say, low income development projects and stuff like that. There could be close deposit niches where basically they can get, because the key thing in the bank is the spread between what your loans are and your deposits. And so one part of that equation is if you can get a low cost deposit base, and then you also can get a very high yielding sort of asset base, and that creates a great thing in combination with an efficiency, because the way it works is you've got that spread, you apply the efficiency ratio, and that gives you your pre-tax income after that. But then you add in sort of the non-bank services into that. So that's sort of like the top level model, the way these companies work. And then try to look for higher yielding but lower risk niches. This could be SBA lending or Freddie Fannie multifamily. sort of lending from that perspective. And sometimes you get government guarantees on these things with SBA lending, which is very nice too. And then the last things we had mentioned before about some of these investment insurers. So there's really two places of growth you can get there. You can get underwriting and investment, and basically the idea of using the investment float to grow the underlying assets. But I think part of it too there is you want to get both engines of that growth continuing to generate over time, decent returns from that perspective. And so these are basically just some of the things that we look for in some of the financial services areas. We're going to look for banks that are generating a minimum of 1.5% return on assets, 15% return on equity, looking for revenue growth in the mid-teens, or growth in lending, and then targets. We want the one thing with banking is we want to make sure the non-performing assets are less than 3%. There's adequate reserves. And then we're looking for niche, well, other niche non-income generating revenue that can be generated on top of the actual spread lending that the institution is doing. We want to, from capital allocation, we want incremental returns on equity to probably be, we like to see them 15 to 20%. Some nice buyback yields. I mean, if you can get mid-teens returns on forward multiples, which means you're probably you can buying back stock in single digit multiples, which I think is doable today in some of the banking sector, especially in some of the smaller banks. Some of the larger banks have gone up, but those smaller banks still have really relatively low multiples. And the way to think about buybacks too is not only the current multiple, but what you're really buying today is you're really going to look at like we talked about in the charts initially before, you have the forward multiple. So if the growth actually materializes, what you're buying today is actually a stock at the forward multiple, not the current multiple. And so that's another interesting aspect. If you can find these companies that are growing that have a decent sort of decent growth rate, the forward multiple is cheap and you're buying back the stock today. So in essence, that becomes even an additional source of growth over time. And then one of the key things that I think people have mentioned before is sort of the Buffett test, or sort of an EPS plus growth around 40%. That's sort of our goal. And that's what we try and find in terms of the businesses that we're interested in trying to invest in, trying to have that at least as a starting point. And if the growth materializes, then over time, what's going to happen is that number will change, but it provides a good entry point in terms of trying to find interesting situations that are at modest valuations. These are just sort of these are some examples of banking stories in terms of where have we seen these kind of situations arise. And here are some of the areas they have a decent amount of processing. So that's an example of FFP Bank Corp. There's brokerage assets. There's a company called Axios that basically does that. Buying more from loans, that's Northeast Bank Corp. Treasury, low income incentive, that's United Bank Corp of Alabama. So this is where we sort of found stuff in banking as a service. There's a number of guys that are doing that also. There's guys like the Bank Corp and and Pathward that are basically doing that. A lot of times in these cases, we like to find led by an entrepreneurial CEO that basically can he's got an entrepreneur, but he also has somewhat of a, given that banking's a levered type of institution, he needs to have some risk control or risk awareness. And I think that's what in all the CEOs that we own, or the companies that we own, have that sort of risk awareness. There can be some consolidation over time. There's geographic synergies, and there's also service synergies in terms of those are more of the back end type of things they can do. And the way that these things are measured is by net income ROEs and then incremental ROEs over time. So again, we're just trying to find things with long runways and consolidation. That's one of the key things. So if we find a company that's generating a good amount of capital today, has done it in the past, we want to make sure there's a long runway so they can continue to do this over, let's say, the next 5 to 10 years. So at least we can say, okay, that's where we as investors today are gonna get the advantages by that growth over time, and possibly the multiple adjusting also. So that's sort of like where the reward is on these things. And so, there's different areas in terms of consolidation life cycle. And some examples here we give you is Northeast Bank. It's very early stage. There's not many people that are out there in terms of orphan loan purchasing. There's more of a mid stage in terms of consolidation. FFB Bancorp has some loans in certain markets, and then there's more of a mature stage. So basically, depending upon where the market is, we have different sort of consolidation aspects of the business. And then the real question that we ask for in a lot of these cases is the innovation. There's innovations happening all the time. Is it disruptive or enhancing? Disruptive could be online banking and processing. And then the other thing is enhancing is transaction processing and import export services. So these are some of the case areas where there's new innovations in banking. There's a lot of sort of these online banks. And so the real question is will the company be a beneficiary of that, or are they going to be a victim? And I think the companies that we like are the ones that are the beneficiaries of that are hiring teams. For example, we've got an FFB Bancorp. The management team's actually hiring new technology folks to actually be able to provide transaction processing and other sort of Rails type services to their customers. So that's actually becomes enhancing over time. And then saying like basically these can be enhanced by appropriate allocation. And these are investments in enhancing products and services. Like for example, FFB, they've got processing, and then they've actually done a white label point of sale system that they sell to customers or that they provide to their customers. And then they develop with their own products and services or adjacent. Again, FFB is a perfect example of that. And then there's buybacks, which I mean, all the most, yeah. So all three of the banks that we own basically do have done buy have done and will continue to do buybacks at this point. And then sort of this is sort of a more of a this is the other sort of segment we've sort of been examining, and these have sort of been compounders. And compounders as basically it's organic growth as a baseline, and they use acquisitions as a way to enhance the business. So these are in situations where let's say the end market isn't growing that fast, but you can do acquisitions, synergistic acquisitions to really do it well. And sometimes these are in related businesses where the synergies, let's say if you got common inputs, like for example for Terravest, you can see sort of that perspective. Sometimes they're in businesses that are not related, and really more the synergies of those is more of best practices than buying at a reasonable price. And so what we really see here is companies that can systematically grow. And we've been looking at these. The Argent's an example of this type of a company. We've been looking at a few other ones. At this point, some of the prices are relatively elevated compared to what we normally pay, but we're still trying to work through to try to get comfortable with trying to figure out, okay, what's the good sort of trade-off there of growth versus multiple paid. One of the key things behind a number of these companies is there's an entrepreneurial culture. And sure, and the entrepreneur at the top, and for example, it could be like, let's say, Warren Buffett, um, or whoever the top entrepreneur is, their focus is trying to make sure that the capitals are flowing to the higher return project acquisition. Typically, there's a decentralized culture, and the incentives are basically to increase recurring cash flow and returns on capital. And there's a lot of times there's sort of value-based pricing. So you're not just looking at a specific margin, but you're looking at how can we increase the value to the customer in addition to what we're providing today in terms of additional value-added services or other types of service or product offering you can do. And what in a number of these cases, what you've got companies that are dominating sort of in smaller niche markets, so the competition isn't as great because the market is relatively small, but as an investment, it can become a material part of the company or business that's actually operating. So as an example, one of the companies that we purchased is a company called Argent Industrial. Argent Industrial is a company that's located in South Africa. It's consolidating fragmented steel product and component markets in three markets, the UK, US, and Canada. What facilitated the change in this business from historically is in 2008, there was a new shareholder, a good-sized shareholder that changed the firm's focus. The idea was to sell South African only divisions and purchase overseas divisions. They like to purchase firms on an average of 5 times after-tax earnings, 3.5 times post synergies. So they can get some synergies given that the commonality across these businesses is they buy steel and they can get discounts on steel if they can basically, from a if they buy enough steel, they can get discounts on steel, so that provides some additional income that they can make as part of Argent versus if they were independent and separate. Overall, the steel business and components sort of modest growth around 3%. But the small size of these businesses, this is not a very big company. Um, the average size is only $1 million. That reduces the competition for the acquisitions. The nice thing about the company is they have spend most of their stuff. They have excess cash flow. They only have to spend 25% on, maintenance projects and or additional projects to sort of within their growth. So they have 75% that they can either use, which they've done in the past, to either buy back shares or buy other companies. And then again, like saying, if there's no accretive acquisitions, they've done this. So they bought back stock, and you can see that by the past 8 years, they've bought back about 6% of the stock per year, which becomes material over that period of time, buying back like 40 to 45% of the stock. And that's what I'd like to see. And this happens in a number of these types of quite these situations where if there's no, you know, acquisition that meets the quality and or price criteria, they can buy back stock, especially in a lot of these companies where the price of these stocks is relatively low, so they can make a good return on buying back the stock. The stock of this has typically been in the mid to call it high single digits for over the past 8 years. So it's been very accretive when these guys have done these acquisitions. The returns on equity have been roughly 16%. The return on incremental equity has been 32%. So the return on equity is sort of the starting point. The incremental is the amount that's being added over time. So you can sort of see if they continue to do what they're doing, the return on equity should continue to go up, and it has gone up over time, as we'll see in some of this in these future some of the slides here. So we've got, there's a number of ways they can buy back or they can grow. And these are the four ways that they can, buy back a firm, expand existing market, paying down debt, and distributing cash flow. They use economies of scale to purchase some of the input steel costs in this, and so that's where a good of the quantifiable synergies are. There's a large runway given the small size of this company versus others, so the opportunity set is relatively large. The growth rate, you can see the annual growth rate with the acquisitions has been 9%, and there's a decent amount of operational leverage here, so you're up to 30% between both the margins going up, which have gone up from 4 to 14%, in addition to the share buyback. So those two have really turned this company that would be modestly growing, I'd say like 9% to the EPS growth. So it really adds a lot from an operational leverage perspective there. This is sort of the management incentives. Management owns 8% of the shares. The CEO owns 6%. Compensation is 50-50 cash stock base and incentive. Cash incentives are based upon things like profit, EPS, and return on capital employed goals. And there's equity incentives, which is basically the stock piece of this, and it's based on employment and then profit performance. So in essence, and the nice thing about this is that there is some plans that are based not only at management, but a lot of people down the chain in the company will basically get these incentives, and they have generated the incentives. So they'll set out a certain amount of here's what we think that you're going to be able to do. And if you beat it above a certain percentage, I think in the case that they disclose, it's about 1.5% above, let's say, this return on capital goal, then in essence, everyone gets a bonus. So I think it's a very, for given how small the company and the space in it, I think it's a great program. This company gives no options. Basically, it's just the equity compensation we mentioned before. The top three executives' compensation is 9% of net income, which I think is a really great thing for a company of this size. Usually, companies that are small like this, it's only an $80 million company. Usually, the executive compensation is usually a lot higher than that. And so here's the return on incremental analysis we had mentioned before. There's 2008, and you can see what's happened over time is the returns on incremental capital are in the 30s. They purchase firms at an average price of 5 times. So that gives you about a 20% going in return on an after-tax basis. And then there's additional synergies and other things that are added over time, which gives you that incremental 10% return. So it's really a balance of a combination of buying these companies at a relatively cheap price in combination with adding value over time to these businesses. And then as you can see, what's happened is the returns on equity have increased from, I would call it like mid single digits to mid double digits. And if they continue going on, I think this can even go higher as the returns on incremental capital are in the 30s. And then you can see since 2008, sort of the buybacks, that's when they started doing a significant amount of buybacks. It became more accretive because what's happened with this company is that despite this increased better performance, the earnings multiple lagged. And the nice thing about this business is they're positioning the business away from South Africa and really going more towards the US and UK and Canada, which in my mind are probably those are more stable markets than South Africa is now. So here's an example, sort of a forward-looking valuation. If we just make some simple assumptions in terms of revenue growth organically, probably let's call it around 5% and 5% from M&A growth. We've got operational leverage, which adds about 10% to this business, and then share buybacks of 5%. We probably can get like, mid 20% sort of EPS growth. And then in the long term will actually provide a pretty decent growth, you know, multiple. If you take a look at right now, it's selling around 5 times. It's selling around 1.7 times the forward multiple. But if you say it's even or 5 or 10 times, you can see the appreciation potential here from that perspective. So you not only have some nice growth, 20% growth, but then in addition to that, you'll also get a revenue or a multiple adjustment if these growth forecasts come to fruition. And then just to give a sense of what are some other sort of what I call metal bending industries, which is sort of like what this company does, companies that basically do metal bending. As you can see, they're selling at a pretty good sized discount to those businesses. It has the highest EPS growth. It's relatively small, so it can do that. And I think that's sustainable. One of the higher margins, the earnings multiples relatively low. And in terms of the Buffett test of earnings yield plus growth, it's at one of the higher multiples from that perspective. And so that's it. I mean, that's primarily, the review of the portfolio at this point. I think we're looking at some, like saying, some real interesting stuff going forward in terms of different types of businesses. We have, like saying, we have trimmed the portfolio of situations where the revenue growth has not materialized, or the earnings and cash flow growth has not materialized as we originally had thought it would, and we replaced them with situations where we thought the probability of that was higher, or there's a good amount of margin of safety, and the segments where that has sort of led us to, in terms of finding the combination of modest multiples and higher growth potential has been financials, banks, et cetera, and then also some insurers, and then also some other things that we're looking at in terms of distributors, but then also some of these compounders. I mean, these compounders are interesting. They have some really interesting and great models. I think one of the challenges has been is trying to find them. Um, a lot of them have already been found, and and their growth and their potential is reflected in many cases in their valuations, and trying to find situations where that isn't the case is sort of like where our focus has been in that sort of segment of the market. And so that's it for this quarter. I don't know if anyone has any questions or any follow-up. Um, we
Keith,
can
I had somebody that
sure.
submitted a question online. They just wanted you to speak to Ashtead,
Mhm.
specifically, given the slowdown in growth and where things stand.
Sure. The Ashtead was one of our core holdings for a number of years and had done relatively well. But the one thing that we've noticed over the past, I would say, the past 12 to 18 months is Ashtead's return on capital and just overall return on equity has slowed down um, from from where it had been in the past. With the reduction in return on capital, I mean, one way I sort of try and take a look at it just on the back of the envelope is say, okay, if we've got the ROE, multiply it times the the retention ratio, which is one minus the payout ratio, what kind of implied growth can we get from that? Plus the dividend yield. And so if we do that for Ashtead, for example, we get so roughly the ROE is roughly, call it like 20% after tax. The distribution amount is around 40%. So at 60%, so you get 20 times 6 gives you 12 plus 2% dividends. You're getting around a 14% total return. The multiple is it's currently trading at is like 17 or 18 times. And so that's changed from historically. I think historically we thought they could generate higher returns on capital and subsequently returns on equity, but that's failed to materialize. Let's put it that way. And so that's why we've sold and moved on to other situations where where the combination of growth and multiple have a better risk reward from that perspective.
Great. Thank you. So, another question came in through the chat. So, could
Mhm.
you offer your current thoughts on North American Construction Group, especially considering how the stock prices moved down with their operating performance?
Okay, again, North American Construction Group is another one where at this point, we've sold, and the reason has been just again, the lack of meeting the expectations that we had thought in terms of returns on invested capital. Before we bought them, they had a really good sort of increase of that going well. The other thing that we've also noticed with the business, it's a pretty capital intensive. And the capital intensivity is something that makes it much more of a challenging. And I think our initial thesis on it was sort of, I would say to a certain extent, disproved. I mean, we were counting on the Australian acquisition has turned out to be an awesome acquisition. They're having a much more challenges in the oil sands. And if you look at the work that they're doing in the oil sands, in theory, that work could be done by the companies that are the contractors themselves. I mean, they're doing overburden work, which is the first in the oil sands. You basically get rid of all the trees and the other stuff that's on the top. They do that first, and then the companies themselves come in with their own trucks and transport the oil sands to the processing facility and back. So to a certain extent, that's that was always a risk there. And I think initially when we bought into it, we underestimated that risk. And so it's a challenge. I mean, the business is a challenging business. Part of the initial thesis was that we thought that they may have been to a certain extent shielded from the competition and what's really going on there, but um, because of the rough environment where they were at. But I think in terms of the numbers that have been reported, I think it's continued to be a challenging situation. I mean, in my opinion, their Australian acquisition saved their bacon. If they hadn't bought the Australian business, which is doing well, it would be in a much worse condition than it is. But I think the core business at this point has really created some challenges, and that's why we ended up selling and moving on to something that we thought was a little easier for us to sort of estimate or necessarily predict what the economics of the businesses is going to be going forward. But they did have a really good run there. But again, it's been challenging in terms of trying to the North American business specifically has been challenging from that perspective. I think management's done the best they can with the hand they've been dealt, but I think what we've realized is the hand has become increasingly more difficult with the some of the oil sands guys deciding to do the stuff internally or from that perspective. So I think that's primarily the reason that we sold. And we see some of these other situations where we can get companies in mid to high single digit multiples growing at 20% with none of the with less uncertainty. That's probably the best way to put it than North American construction. North American construction initially that was sort of our thesis there, but I think the uns you know I don't think they met our initial expectations, but then in addition, just the uncertainty is a lot higher there than probably what we initially thought when we went into the position.
We had a question come in on Vistry, Keith,
Mm-hmm.
and what is invisible to the market that you're seeing in Vistry? How long would it take the value to crystallize, and what might those catalysts be? And can you speak on, what's holding the stock from achieving the returns management's projected since it was countryside.
Yeah, this tree is a challenging one. I mean, that one we still have in the portfolio. Um, it's been like you're saying, it's I think the one thing that we underestimated with that one, and we'll see how this sort of turns out, is, they seem to be, given that their model is really dependent upon these local sort of organizations or government, quasi-government organizations. That dependency, I think, is tough to sort of estimate what it's going to be, especially given that the nature of housing in the UK, I think, is a little bit different than in the US, just from a perspective of, you know, some of the people being more, okay, it's less, I would say less capitalistic and maybe more of, okay, we should deserve something because we're giving you this break kind of thing. But, you know, I mean, I think Vistry is an interesting one because it does have that huge option, but that option's been there, that's been countryside, and it really hasn't played out. It's just sort of bounced around a lot, even with the new government that's come in and said, okay, we want to support housing, then it rallied, but then it always seems to have an overhang to it. I think the other thing that's hurting them and it's overall home builders in the UK and even in the US is just the relatively high interest rates because that adds as a damper on top of it. Um, it definitely has been a challenge. Like saying, I mean, at this point, we're still holding it. But it clearly has not met our initial expectations, and those are the types of businesses that we look at and constantly monitor to basically see, okay, I guess we put them more on a watch list as opposed to one where we don't have to be as concerned about those types of situations. And let's say in a company more like a TerraVest or some of the other businesses where basically it's not as, I would say that that one also is somewhat dependent upon the government too, in terms of the government's, you know, willingness, not only the national government, but then the local governments in terms of that. So we're saying that, I mean, at this point, it's just something that we're looking at, and I think I would say again, going into this, one of the errors that we made there was basically um, misjudging the amount of uncertainty that this model really has. And then, so I mean, I guess as a shareholder, you really need to say, okay, is this the kind of uncertainty that you feel comfortable holding? And if things turn out okay, it may turn out all right. I mean, but management a number of times has said things that just haven't come true, or it's been, I guess I should say it hasn't come true. It hasn't come true on the timetable that they had said it was. And so you know, they eventually may come true, but are you okay with a company that may not meet expectations? But then eventually we'll get there if things play out the way that they've sort of laid out from that perspective. So I mean, I think
Okay, and
that's
then staying on the home builders, I guess
mm.
what are your thoughts on builder first source? Again, weekend markets, but maybe good positioning. Um,
Oh yeah, no, I mean builders I still am very, very positive on. I think, it just seems to be, it I look at it, if you just look at its returns on equity, are very nice. The returns on capital are very nice. It seems to be in a great position. Again, but I think it's one of these cyclical businesses that are tough. I mean, Vistry's sort of in the same boat. In a cyclical business, you're gonna get ups and downs, even if the business is of high quality, because the way that these stocks, I think, have a tendency to trade is they'll trade with other companies that are in sort of that business, even though the cash flows for those businesses may be more volatile. So I think that's a challenge in these businesses. If you find a business that's generating really good returns, but is going to be trading more like other companies in the business. And so I think that's the challenge. And the real challenge in the US is for builders and the other companies is okay, you know, what's happening with home building in the end. But in essence, I think builders has built something that it's a little bit different, especially in their local markets, in terms of being able to focus on the trusses and the woodworking in those markets, developing, continuing to deepen the moats in those markets in terms of developing the types of things that the thing that's been, I think, historically surprising, and I haven't heard anything different than this, is that they have their builders does have a product. I think it was, I don't know if it was from BMC or from builders originally. They had a lot of these pre-made components, and that really had the uptake of that really hasn't really happened, even though it will save home builders money over time. I mean, I think there's some longer term trends that can really do well, but clearly now there's if you look at just the price to value component of it, it's just, in my opinion, it really seems to be out of whack. I mean, because if you take, let me go back to, give me a second here. There's a slide here that can give you some idea of what's going on there with the pricing. But yeah, right now, Builders First Source, I mean, we're probably at like a 15% growth at, six times earnings for one of the probably the best distribution company in the business. I mean, the only potential cap to the upside I could see on this thing is that if it gets taken over by somebody and they're able to get it for a good price. But I mean, I guess like QXO could potentially done they've done that with Beacon. But I mean, other than that, I think this is again, it's cyclical, so it's tough to know when the timing is going to be on this and how that's going to turn out. But I think it's, if you just look at historically what it's done and just the returns on capital and the returns on free cash flow, I think it's, they had the COVID bump, which was a huge bonanza for them, and now it's come down. But there's this and a lot of the other building products companies I think are going to do relatively well going forward because I think they've revamped their business models. These businesses are clearly, in my opinion, totally different businesses than they were in the last cycle. So when they were going through COVID, the cycle was, it was much pre-COVID. The business was much smaller and it just didn't have the quite the quality in terms of the returns on capital. These guys, the returns on capital have just gone up tremendously, even after COVID. So I mean, that's part of the issue with some of these businesses. Asbury's sort of the same way, is that the businesses are different than they were pre-COVID, and there is some, I think, sense in the market that a lot of these businesses are going to revert back to what their mean was before COVID. But I think what's happened in a number of businesses is they've gotten a lot better, so they shouldn't revert back to the mean. They should actually be to some higher multiples. But at this point, they do, what the reality in the market is that they do appear to be reverting back to sort of like on a value base, on a price to earnings basis, seem to be reverting back to what that mean is. But I think the underlying business quality is higher, and so I think that's where the I guess you could say the variant perception is on some of these businesses from that perspective. So, but yeah, no, I think built that's the challenge with some of these. I mean, Asbury's done a little bit better than Builders, but the frustration with Builders is that despite the changes, it's still trading the way it's trading just like a normal lumber distributor as opposed to a very high value added service provider. So, and that's probably just a matter of time for people to change their opinion on that. And when they see enough evidence that the returns on capital still are up relatively high. And the one thing that they've been able to do, which is great, is they've been a heavy repurchaser of stock. And so that's really added to, that's the one way that management, if they disagree with what the market is saying about them, they really can make a difference. And the nice thing about builders is it's got somewhat of a capital light model. They don't need a whole lot of cash flow to run the business. So they've got a lot of cash flow that they can aggressively buy back stock, and they continue to do that. So I think over time that will be rewarded. So that's an example of, let's say, a company that has that flexibility versus, let's say, the ones we previously talked about, like North American Construction. North American construction is a little bit more capital intensive, so it doesn't have as much firepower or flexibility as someone like a builder's, where basically there's not that much, it's not that capital intensive, so they can use the stock to, they can buy back stock to really it's something that management can do if their stock price is languishing a lot lower than what they think the value of the business is to really create value over time.
Great. Well, Keith, we're right up at the 2 o'clock hour, so we want to thank everybody for joining. I know one direct message question came in, but we're going to have to cut it here. So I'll share that offline, and
Okay.
Keith will reach out to this participant as well. Okay, so thank you, everybody. Really enjoyed the discussion, and we look forward to doing this again soon. Thanks,
All
Keith.
right. Thanks. Have a good fall.